Interest rates are the lifeline of the real estate business. Why? Obviously, for all of us, we're all leveraged. We all buy real estate with the idea of leveraging, and the way that interest rates go up or down has direct impact on our business. If this is your first time visiting my channel, hello everyone, my name is Mikhail Krikchin. I am a commercial real estate broker. I'm also an investor, and I operate in the Quebec and Ontario markets in Canada. The video that I've done today is to focus on 3 points I'd like to share with the audience. Number one is looking at the trend line of interest rates, how it shifted last year. A 40-year downward trend line broke last year, and now we're in this complete new trend that none of us really knows where it's going to be going over the next couple of years. Secondly, I like to also look at the banks, why they pay attention to interest rates so much, obviously, for giving their loans, and how the way interest rates are going up and down has direct impact on our commercial loans. And thirdly, I'm going to look at, from a positive angle, what we can do on our side to be able to fight this off, and what we can do as far as net income is concerned, how paying attention to increasing the net really has direct impact on our bottom line, how it can help us tremendously with this rising interest rates. Let's get started with the trend line. If you look at the 40-year chart of the U.S. Treasuries, why the U.S. Treasuries? Because really the 10-year U.S. Treasuries are used as a proxy for mortgage rates. These 10-year U.S. Treasuries are really some of the safest instruments in the world for investors, and whoever wants to invest in the U.S. dollar, they buy U.S. Treasuries, and the way these trend up or down gives us a very good indication how the mortgage rates are moving as well. If you go back to the 1980s, until last year, this trend line was straight down. What that means is that real estate owners who had bought properties, let's say in the 1980s, and if they did nothing to the properties really, as long as they held onto the property and kind of did the bare minimum to increase net income, if that, just by the fact that as the time was advancing, the mortgage rates were going down. And what that means is that the actual property cap rates were going down. So the property value was increasing just by the owner holding onto the property. So everyone looked like a genius. The year 2000, same thing. It was actually even lower than the previous 10 years and so forth. And this trend continued until really last year. Now, the trend has broken now. And what that means is that the way the trend is broken now has direct impact to what's going on to the mortgages. Why? Because the way the banks are going to be always looking at loans for commercial properties is the banks are paying attention to what's going on with net income. And there's a thing called the debt coverage ratio. Typically a bank, what they would do is they would look at a property, figure out what the net income on that property is, and then remove maybe 30% from the net and say whatever is left, 70% of it is how much we're going to be okay with the loan or the mortgage on this property. So meaning that if the interest rates are higher, then what that means is that all of a sudden the bank is going to be able to lower less or loan less on a property. If the interest rates are lower, the bank's going to be able to give a bigger loan on this property. And if you look at specific examples, let's say if you look at the mortgage rates that we had in Canada in the early 2000s. In the early 2000s, the mortgage rates were going to be hovering, let's say, in the 5 to 6% range. 5 to 6% range, a property that had $100,000 net income would have got a loan from the bank from, let's say, around 1.1 to 1.2 million. The same property, if we advance to, let's say, 2011 to 2018, in that time window when interest rates were hovering around 3 to 4%, that same property on this $100,000 net income would have gotten a loan from the bank in a range of 1.5 to 1.6 million. So that means that the borrower was able to borrow so much more financing just because the interest rates have gone lower. Now all of a sudden they can get a much higher loan amount. Now, if you go to COVID times, 2020, as we all recall, interest rates went almost down to zero. June 2020, interest rates were mortgage rates were as low as maybe in the range of around 1.5 to 2%, meaning that on the same property of 100,000 net income, now all of a sudden this borrower was going to be able to borrow in a range of 2 to 2.1 million. Imagine that, 2 to 2.1 million. And if we fast forward to today, where the CMHC insured mortgage rates are going to be in the range of 4.2, 4.3%, now on $100,000 net income, the same borrower is going to be able to borrow 1.4 million. So, to put this in perspective, if somebody had bought a property in the year 2000 and that put the maximum mortgage on it of, let's say, 2.1 million, if that same owner went back to the bank today, let's say in 2 years' time, their loan has gone down a little bit. It would not have gone down that much, but let's say it went down a bit. Now the same borrower goes back to the bank, but now if mortgage rates are going to be at 4% versus what they were at 1.5% 5 years ago, all of a sudden they will not be able to even qualify for the same mortgage. What that means is they're going to have to extend their amortization or potentially pay down some capital on a mortgage so that they can qualify for this mortgage. So this is really risky, and it could be really serious trouble ahead for some of these owners who are not paying attention to this. Now, just hoping for the best is not enough. We can't just say, let's hope for the best and hope rates go back down and so forth. That's not really a good strategy, because then that means we're kind of praying to make things work in our favor. Interest rates are the key, yet there's a way for us to fight this, and that's going to be by, as a property owner, as a real estate investor, by yourself really paying attention to what's going on with your net income. If you're going to increase your net income, obviously there's two ways of increasing it. You can increase the net income by either increasing your gross rents of the property, or you can be by lowering your expenses, maybe changing insurance companies, maybe trying to figure out what you can do to save some energy costs for the consumption, and different ways of tackling the net income. By you increasing the net income by a single dollar on a monthly basis means on an annual basis, it's going to be $1 times 12 months. It's going to be $12. $12 at a 5% cap rate means this property has now earned you a $240 price appreciation. So a $1 increase of your net on a monthly basis gives you $240 appreciation in the property value annually. So what that means is that that's why it's very important, really, as real estate owners and real estate investors, to really we pay attention to the net income, increase the net as much as you can, and do whatever you can to lower expenses, increase your revenues, and make sure you can stay ahead of this interest rates hikes that are really going against us. So to summarize, I'd like to basically just focus on the three things that we saw today. So number one, it's going to be that the trend line for the interest rates has really broken. Now we're in a new world, in a new environment. None of us have seen this before, really, because this trend line was downwards for the last 40 years. And now we're going to be in a new trend. Either trend maybe will be staying the same as where it's at now, maybe going a little lower, a little higher, or maybe the next 40 years we're going to be seeing increasing interest rates. So no one knows. Let's pay attention to this. Number two, the banks, since they're focusing so much on net income in giving their bank loans on the properties, then us, what we have to do as real estate owners and real estate investors is really focus on the net and do whatever we can to increase the net income, to then increase the property value and be able to fight off this rising interest rates by us increasing the net income and our property appreciation. So I hope you liked today's video on interest rates and the net income. And if you like this kind of content, follow my channel.